Let's talk about financial acumen for startups. So typically you're going to cover a couple core segments when it comes to talking finance for your startup, and I just want to give you a quick preview. So first, you've got financial statements. Your big statements are going to be your income statement for all of your revenues and expenses and profit, your balance sheet, which is going to cover all of your assets, your liabilities, your owner's equity, and everything in between. And then last but not least, your cash flow statement, which measures and tracks and manages all of your day-to-day cash flows, the inflows, the outflows, and of course, making sure we understand where the money's actually going. These things come up very often. Typically, they come up, though, in two specific situations. One is capital raising, because, of course, investors want to know the state of the company and also a sense of where it's going to go. And typically, your projections are going to be based off of your current performance. Second is internal planning. Startups are, generally speaking, not just kind of a wait and see anymore and hope we grow. People set plans, people set goals. And it's not that you're expected to hit every single goal, especially the very honest, very brutal internal goals, but you got to have them. You have to have a measure against, because if you don't have goals and standards and measurements, you have no idea what if you're succeeding or failing. And that's really difficult and really unnecessary when it comes to having financial statements, because that's what they're there for, to measure, track, inform, and make good decisions off of. Next, you've got budgets and forecasting. Budgeting, very simple. It's how you actually plan to spend all your money over the next month, the next quarter, the next 6 months, year, whatever it might be. So planning through that, very, very helpful. Forecasting, of course, looking to the future, very helpful, especially as a founder, because that's why you get excited. Because if I look forward 1, 2, 3, 4, 5 years, I see lots of revenue and growth and exits and all that good stuff. But also, I see a business worth investing in, a business where you can give it $500,000 today and make money back in the long term. Why do we care about these things? Well, we've talked about this before, but we're going to talk about it again. Rule 1 when it comes to being a founder: don't die. You are lost in the desert when it comes to building your company. You always need more resources. And one of the most critical is cash. And if you don't manage the cash, if you don't manage your assets, if you don't manage your finances, you're going to run into trouble. And by budgeting and projecting and understanding, the successes and failures therein, you're going to get a lot more comfortable and get a lot more accurate managing your finances on the day-to-day. Because ultimately, the projections that you're setting, even the internal ones, they should be defendable. They should be well researched. They should excite both you, the team, you, the founder, but also those that you share it with, whether it's the investor, the advisor, the mentor, the consultant, whoever it is that you're having these discussions with. If people aren't getting excited, it raises some questions. And it's one of those, they shouldn't be seeing you go from 0 to 100 million in 3 years. It's a little far-fetched. But they should see that there's real money being made, that there's real growth expected, and that there's a business worth getting excited about. Last but not least, we have key metrics and ratios. It always comes down to the numbers, unfortunately. So key metrics in startup land typically fall under the KPI bucket, which is key performance indicators. These are your basic building blocks of financial and operational understanding for your startup, because it's about tracking the key metrics that show what's going on. These are not designed to be what are commonly known as vanity metrics. Vanity metrics are metrics that look really, really good. They're things you might put on the website or show to a shareholder, but they don't actually show what's really happening. They show what looks good. They show what might sell. They show what's compelling. But the real brass tacks of use, revenue, cash flow, retention, whatever it might be that we're looking at to really get a hold of what's going on in the business, these vanity metrics definitely don't fall into that camp. So for us, it's really critical that when we look at the KPIs, when we look at the financial ratios or operational ratios, whatever they might be, that we're making them business model and industry specific. Because a B2B SaaS company versus a B2C consumer marketplace company function completely differently, have completely different metrics, generally speaking, and of course they're going to be held to a much different standard because of those metrics. So getting a sense of okay, financial, awareness, having a bit of financial acumen isn't going to be something that I can exactly dodge as a founder, nor is it something you should really be looking to dodge because, of course, there's a lot of knowledge and a lot of value you can get out of having this kind of skill set under your belt. But if you use it well, hopefully you can see how making these decisions, planning and thinking and adjusting appropriately can really increase your odds of success.